Many traders spend hours identifying a highly accurate price level on their charts, only to place a trade and watch the market run them over anyway. This split-screen chart illustrates the problem. On the left, a trader places a blind limit order and gets crushed as price ignores the level completely. On the right, price taps the exact same level, prints a sharp reversal candle, and launches upward. The trader on the left failed because they treated location, where to trade, and timing, when to trade, as the exact same concept. They found a good zone, but executed without waiting for evidence that the market was reacting to it. To solve this, we use a mechanical system requiring a specific set of tools. This checklist shows what you need: a 15-minute and a 3-minute chart, standard volume, true C and nested C labels, and an average true range, or ATR, indicator. By separating your macro location from your micro timing, you stop guessing. You wait for the setup to present itself, confirm the volume, and execute the trade systematically. Step 1 is the map phase. This 15-minute chart serves as our primary macro environment. We scan this time frame to find a clear, bullish A-wave market structure break. Once the structure breaks, we identify the genesis block, strictly the very first order block forming immediately after the break. We focus exclusively on this initial block because it represents the origin point of the move. This specific zone marks where the largest concentration of the institution's primary position sizing was first established. Ignore secondary order blocks forming higher up the trend. They do not represent the structural origin. Next, we find the genesis block's exact mathematical center, establishing our 50% equilibrium midline. Because this block contains the primary institutional position, we treat this midline as the focal point for rebalancing, the area where the largest concentration of limit orders is typically defended. You now have your macro line in the sand mapped out on the 15-minute chart. This tells you exactly where to look, but it is not a signal to place a buy order. Step 2 is the arrive phase. This requires patience. You wait as the price organically retraces back down toward your mapped genesis block. Do not place a blind limit order. The macro block acts as a loaded spring, but without a real-time trigger, price may slice right through. Step 3 is the hook. The moment price reaches the cyan midline, we drop down from the 15-minute macro view to a granular 3-minute execution view. As price interacts with the midline, shift your attention directly to the volume indicator. We look for physical proof of liquidity absorption, signaled by a bright green volume surge bar, precisely as the wick taps our line. Volume suggests institutional activity, but alone is not a trigger. We must see price validate a momentum shift. We wait for the true C trigger to lock onto the reversal candle, confirming directional momentum is turning. When a volume surge and a momentum arrow converge exactly at the midline, the genesis hook is complete. You now have the specific confluence of signals required to execute the trade. Step 4 is risk management. The exact execution command is to click buy the moment the genesis hook confirmation candle closes. Once you are in the trade, the goal is to avoid being stopped out by minor price fluctuations before the expansion occurs. To protect the position, we measure the exact low of the sweep wick that tapped our midline. This wick serves as the baseline for our stop loss. We calculate a safety net by taking that wick low and subtracting a 0.2 ATR buffer, locking our stop loss at this coral red line. This protects capital from standard volatility. Finally, our target line projects upward, locking a strict 1 to 4.5 risk-to-reward ratio. By waiting for confirmation and adding a mathematical buffer to the stop loss, you account for standard volatility and align the entry with the expected institutional expansion. This zoomed-out chart shows the result. Price expands cleanly away from the hook entry, pushing straight up to secure the 1 to 4.5 profit target. The system works by pairing a macro location with a micro execution timing. Neither concept functions reliably without the other. Commit this framework to memory. Your location is the genesis block. Your timing is the genesis hook. Identifying the structure, finding that first block, and controlling the midline is the method used to systematically capture these broader moves. Open your charting software right now. Locate 3 historical 15-minute A-wave breaks, map the midlines, and drop to the 3-minute chart to backtest the genesis hook response. Prove the math for yourself.